Senior secured loans offer a unique blend of attractive yield potential with some protection against both credit and interest rate risk. At a high level, senior secured loans have the potential to provide attractive risk-adjusted returns and other portfolio benefits. These include multiple layers of credit risk protection, security in the form of asset backing and covenant restrictions, low relative volatility, relative value opportunities, and compared to private assets, greater transparency and liquidity.
Senior secured loans are referred to by a few different names, including bank loans, floating rate loans, and leverage loans. They are commonly issued by below investment grade companies and can be used for a range of purposes, from financing acquisitions to refinancing existing debt to supporting expansion plans. They pay a floating interest rate, a base rate, usually SOFR or Euribor, plus an additional fixed margin to compensate for the credit risk of lending to a below investment grade company.
A majority are issued for privately held companies and therefore come with the support of a private equity sponsor or sponsors. Broadly syndicated loans are underwritten by a lead bank and syndicated or sold to other banks and institutional investors.
Unlike the private credit or direct lending market, broadly syndicated loans are often syndicated to a large number of lenders. As a result, there's an active secondary market for these loans.
As an example, more than $700 billion of loans traded in the U.S. during 2023, which represented just over half of the market. An active secondary market can provide investors with access to liquidity even during challenging periods.
Since the financial crisis, the broadly syndicated loan market has grown substantially in the US and Europe. At roughly $1.8 trillion, it's now comparable in size to the global high-yield bond market.
The majority of borrowers tend to be large companies with diverse businesses that generate anywhere from $100 million at the very low end to $1 billion or more in annual EBITDA.
This is different than in the private credit market, where borrowers for the most part tend to be smaller in size.
There are a number of ways investors can access the broadly syndicated loan market. Examples include separate accounts, commingled funds, retailed funds, and collateralized loan obligations, which are essentially structured vehicles investing in a pool of loans.
CLOs represent 60 to 70% of the outstanding loan market, and due to their closed-end nature, provide a very steady source of demand for loans. For comparison, retail funds represent less than 10% of the U.S. loan market demand and a minimal portion of European demand.
What this means is that most of the demand and activity for this asset class is supported by institutional investors, which can mitigate outflows and keep loan prices stable, even during periods of heightened uncertainty or volatility.
In addition, an active secondary market allows cash to be quickly and efficiently invested without delay.
For investors, senior secured loans offer a number of potential benefits. For one, the asset class offers multiple layers of credit risk protection.
These loans are typically senior to other outstanding junior and subordinated debt, as well as equity, in an issuing company's capital structure.
This seniority means that the loan's interest and principal payments must be paid before those lower in the priority order. This is important in the event of a default, as lenders and equity holders that are more junior in the capital structure provide a cushion against losses for loan investors.
It also means that companies and their sponsors are often motivated to proactively work with senior lenders before a stressed or distressed situation arises to identify agreeable and potentially attractive solutions.
Senior secured loans are also secured by some or all of a borrower's assets. Many different assets can be used as collateral, including real estate, equipment, vehicles, and intangible items like software or trademarks.
This security provides investors with additional credit risk protection, as secured loans typically have a first priority claim on a borrower's assets.
Because senior secured loans are issued to below investment grade companies, investors may be concerned about the potential for defaults. But it's worth noting that the long-term average default rate for U.S. and European loans has historically been relatively low, around 3% per annum for both markets.
Further, given their seniority and security, when there have been defaults, loans have offered historically high recovery rates relative to other asset classes. From 1987 through 2023, the recovery rate for senior secured loans was just over 80% of the initial invested amount.
That said, default and recovery rates, when viewed in isolation, do not necessarily reflect the impact to total return for a loan. This is because the interest paid during the life of a loan adds to the total return, while the active secondary market allows investors to add or reduce their exposure to the loan over the life of the investment.
Compared to other asset classes, loans have also historically exhibited low volatility. In the last 10 years, global loans have exhibited approximately 2/3 of the annualized volatility of global high-yield bonds and 1/3 of the volatility of global equities.
This is primarily due to the floating rate coupon on offer, which results in low interest rate duration or less sensitivity to changes in rates. In the context of a broadly diversified portfolio, this can help reduce overall volatility and increase the long-term risk-adjusted return potential.
Another key characteristic of broadly syndicated loans is the income component, or the coupon, which contributes to the potential attractiveness and stability of the total return.
For context, the long-term average return for the loan market is around 4 to 6%, which is similar to the average coupon, particularly in a lower rate environment. While the potential for price appreciation also contributes to total return, it has ultimately been the level of support from the income component that has minimized the number of negative years in the loan market. Over the last 25 years, there have only been 3 calendar years in the US and 4 in Europe with a negative total return.
Because loans exhibit low correlations with other asset classes, they can also serve as an effective diversifier in a broader fixed income portfolio. In the last 10 years, the global loan market has exhibited a low to negative correlation with traditional investment grade markets and a less than perfect correlation with other high yielding fixed income markets.
While the US and European senior secured loan markets both offer exposure to below investment grade credit, the factors driving each market can and often do vary.
This is partially a result of the technical factors mentioned earlier, including new issuance volume, CLO issuance, and flows in and out of retail mutual funds. It is also a result of potentially differing economic outlooks or the impact of geopolitical events on each market.
Changes in technical and other factors can cause the market price of a security to decouple from its underlying fundamental value. Investors with long-term horizons may be able to capitalize on these market dislocations by buying securities that are underpriced or selling securities that look rich relative to their fundamental value.
Given how quickly market prices can react to changes in technical factors, a strategic allocation to senior secured loans can facilitate the timely capture of evolving relative value opportunities and position investors to benefit from the compelling income potential during periods of stability.
A global strategy can provide access to a larger and broader opportunity set, giving managers and by extension investors the flexibility to capture opportunities as they emerge across the two regions.
While we see many benefits to investing in senior secured loans, it is also important to consider the potential risks. Although this asset class is senior in the capital structure, investors may still be exposed to principal losses in the event of a default or price volatility.
For this reason, and to make the most of the investment opportunity, it is critical that the investors partner with active managers that have a presence across geographies and the ability to analyze and price idiosyncratic credit risk.
A deeply resourced team is also critical. The senior secured loan universe consists of over 1,600 issuers. To truly be able to underwrite the fundamentals of a company, you need a large research team that has the scale to perform the rigorous credit analysis required.
Having team members in each region that regularly interact with trading counterparties and meet with local management teams and sponsors is also crucial, especially when it comes to evaluating relative value opportunities across geographies.
Given the evolution of the loan market over time, it's also important to partner with a manager who takes a disciplined approach and has proven experience through market cycles.
Although different environments bring varying challenges and opportunities, long-tenured managers with deep relationships across the market are better positioned to navigate periods of uncertainty.
Finally, it's important to partner with a nimble manager who has the ability to quickly and efficiently capitalize on relative value opportunities as they arise.
Being able to provide dynamic solutions in evolving markets is key and can ultimately put investors in the best position to achieve attractive, long-term risk-adjusted returns.